is to show you an in-depth into financial statements. The purpose of this is for you to have an in-depth understanding of it, so that when you are when you are completing this type of question, you know what would have went into it and you know how it works. And then I'm going to do a cash flow. I'm not sure if I'll finish in the time that we have, but I left everything as answers like this, so that we could do it faster. Okay, so I'm gonna start. So the first thing you need to do, besides reading the top of the question, you have to go all the way down here to required. Required will tell you everything that you need to do, right? So it says generalize the adjustments. We're not gonna do that. So yeah, we're not gonna do that. Let's put them in the general journal. Then it says draft the statement of financial position of meat lovers as of 31 March 2017. So it's very important that you see that the year ends at the 31st of March 2017. So if you see here, I just forgot to write it there. If you see here, the year ended March 31st, 2017. So it starts the next day. So it starts the 1st of April. So our year ends at the 31st of December and it starts the next day, the 1st of January. So that's the fastest way you can get to the beginning of the year. Then we're gonna do a statement of profit and loss and other comprehensive income, a statement of changes in equities. This is the one that I told you yesterday, that it's usually now it's embedded in your statement of financial position, but it is a statement on its own. Then prepare all the relevant notes. Okay, so we're gonna start with the notes. So we're gonna start with the notes, and this is what you're seeing here. You have a couple of them, and here they are. So I'm gonna go back to the beginning now. So if I go to the beginning, okay, can I remove this thing? Seriously, I don't need a navigator. Thank you. The following pre-adjustment trial balance appears in the book of meat lovers at the end of their first financial year. Pre-adjustment trial balance of meat lovers 31st March 2017. These balances here, unless otherwise stated, like as you see here, are at the end of the year, the 31st of March. If it says another date here, then it's of that date. This one is for this date, so forth and so forth. All right. So I'm gonna come down here. So the first one says owner contributed equipment with the cost price of 250 rand. This will go. This we have to calculate depreciation on, which is this note over here. I don't usually like to start with this note because here's the rest of the stuff. So I'm gonna skip that one for now. I'm gonna come back to it. The second one, the owner, Mr. Korisaki, took trading inventory with the selling price of 2.3 for own use on the 29th of March 20.7. The business trades at a constant markup on selling price of 44.33%. This transaction has not been recorded. So remember I showed you how to do markup. So I'll come over here for a second because this is the only place I have space. I'll write gross margin. I'll go cost price. I'll go gross margin. You know your selling price is 100% because it's based on selling price, right? And then this would be that fraction here. Just want to see. I want to see if it's multiplied or it's added. It's added. Okay. So we have that. I can't write it to write it as well. So I'll write it like that. Okay. So if I have 100 and I subtract this, I just want to see if it will give me the right answer, even if I don't have a plus there. 55, let me see. 55, yeah, that works out fine. Okay. So that's us building our table, right? So now what we're gonna do is you're gonna take this amount here. So we're gonna say 2,300 You know, multiply it by what we want over what we have. What we are looking for is cost price. So we always show drawings at cost price. So I'm going to look for my cost price. I'm going to be dividing my selling price is what we have, and I'm going to get 1,280 rand and 3333 recurring. Okay. Then I'm going to come over here. So I'm going to take the rand value. And there it is over here. But before I get to that, I want to show you something. There by number 3, so just keep this number in mind. There by number 3, according to the physical stock take, the following was on hand as on the 31st of March 20.7. So here you have your consumable stores, your stationery, your trading inventory. Okay. So your stationery is an expense account, the same as with your consumable stores. Okay. Now, you would agree with me if I said to you that having a pen or a dictionary or a calculator is not an expense to the business. Rather, that is an asset to the business. The problem is that pencil or ruler will depreciate so fast that by the time we do our books at the end of the year, it would have become an expense. Because remember, depreciation is an expense. So basically, you're taking the asset and you keep subtracting its value and putting it into an expense account called depreciation. So you're turning that asset into an expense slowly. So by the time we get to the end of the year, it would already be an expense. So we take stationery as an expense to begin with. However, if you do have stationery left over at the end of the year, then you're going to consider it an asset until you use it up. So this is stationery at the end of the year. This is consumables at the end of the year. This could be anything. This could be food that you're selling. This could be stationery for one. So it doesn't necessarily mean this edible stuff. It's just things that you consume I just can't think of an example now. It's things that you consume on your daily operations of your business. Maybe tea bags. That's still part of stationery. Maybe the calculator. Okay. So then I'm going to go up here. You will see that the stationery at the end of the year, according to the system. So remember, or maybe not remember, but if you go to macro, when they sell to you, where they scan or macro, whatever it is, whatever they sell, they scan a barcode. So that basically that system works in such a way that it says, okay, we had 10 calculators, 5 left, 5 were bought today, so you have 5 left. So you always know how much inventory you have on paper. So this is the system telling you you have 88,000 worth of inventory on your paper. However, you walk around, you actually physically do a stock take. You physically do a stock take and you find that instead you have 85,000, okay? The first thing you do, you go over here to your inventories with an M for some odd reason. Let me just remove that M. You go to your inventories note. Immediately remember the statement of financial position. You always show the financial position, not the movement, right? So you put 85,000 there, but you must now explain how we got to that 85,000. Okay. So first things first, if you look over here, you have that 88,000 that we had, right? And then you're going to say minus the drawings, because remember, drawings will reduce the value of stock. Remember, this person took inventory. Fine. So if it was drawing in the form of cash, you don't put it here. So it depends what kind of drawings it is. If it is drawings in the sense of equipment, then you also don't put it here. It's only if it's inventory. So we subtract that. So I'm going to come over here and show you. So we have 88,000. I'm going to minus the 1280, right? The one that we just calculated up here. Then I'm going to subtract the 85,000. So the purpose of me doing this is I'm trying to get to 0. I want to see if I can get to 0. And I see I don't get to 0. So I have 1,720 Rand of unaccounted stock. It could be missing. It could have been damaged. Whatever the case may be, it's no longer with us. I am going to subtract it as well. And I'm going to consider this as cost of sales. Okay. So there I have 85,000 As is, where's my statement? Where did I put it? Here it is. Inventories, I have, why do I have 85, 88, 500? Hold up. Just want to see where it's getting this from now. Is this a different one now? B29 would be over here. Oh, okay, my bad. And the last thing, sorry about that. The last thing is the consumable stores that I have to add over here. I don't know, I forgot about that. And the stationery. So 2.5 plus 1,000 will give us that 3,500 Rand. We get our total. This total we are going to take to our inventories. So if I go back to my inventories, I have that 88,500 over there. Cool. Then I go back. Then the next thing, there's an increase the allowance for credit losses by 990 and adjust the allowance for settlement discount granted to 5,000. Okay, so now I'm going to open my receivables note. Okay, so here's my receivables note here. If I go, let me just go to it. Okay, if I go back to my trial balance and I find my debtors control, my debtors control is sitting there at 345,000 Rand. Okay, so that's the first thing I'm going to do. So if you see over here, up here, I have 3,445 Rand. Okay, so that's what I have over there. Okay. So they said I must adjust, and what you would do is you would put that amount here in brackets. So you wouldn't necessarily put it here immediately because there's still some things that you need to add or subtract or whatever the case may be. Okay. So then they said here, increase the allowance for credit losses by 990, right? And then you must adjust the settlement discount one to 5,000. So I must look for them in here first, what they were sitting at. Okay. So I see my allowance for credit losses, the one that they said I must increase it by 990, is sitting here at 3,456 Rand. Okay, as of the first of this the beginning of this month, this year. Fine. So I'll go there and I put it there, and then I add 990, and I get to a new total of 4,446 Rand. You will notice I'm subtracting that figure because I need to remove it from my books. Because remember, this is money that we are putting aside, so you need to remove it from our books. Well, not necessarily remove it from our books, but you're showing that it's money leaving. It's an outflow of money. Okay. Then they say we must, where is it? Then they say we must adjust. Okay, what's going on with my mouse? We must adjust the allowance for settlement discount granted to 5,000. So if I go back up here to look at what it's sitting at 5,800. So to take it down to 5,000, I need to subtract 800. So you will see here I'm subtracting 800 to make it 5,000. So this is money coming back in. This one is an expense. The movement of 990 is an expense. And then the inflow of 800 is an income. So if I go to my income statement, and I know I'm going back and forth a bit, I just want to show you where they are. So if I go back to my income statement, remember the 800 was an income and the 990 was an expense over there. Okay, fine. All these because they keep popping up. Okay, fine. Let me see before I move on. Okay, a debtor, Mr. Eisen, has been declared insolvent. Received a check that constitutes 14 cents in the rand from her insolvent state. I guess Mr. Eisen is both genders now. Mr. Eisen's debtors account amounts to 4,000 Rand. This transaction must still be recorded. Okay. So Mr. Eisen owes us 40,000. Okay. So he is only willing to pay us, or he's only able, rather, to pay us 14 cents in the Rand of how much he owes us. So if you look at a Rand, is 100 cents. So he's paying us 14% of this amount. So if I say equals 40,000 is 40,000, right? Yes, 40,000 multiplied by 14%, I get to 5.6 that he's going to be paying us. And then if I subtract that, let me say 40, 1, 2, 3, minus this is how much he is not able to pay us. That's how much is going to be credit losses. Okay. So from my I'm going to have to subtract it from my debtors control, both amounts, because in my books, he owes me money, right? So I go over there. I subtract the 5.6 first. This is the amount of money he's going to be paying me. And then I then subtract the amount that I'm going to write off as credit losses. All right. So now my debtors control looks like this. Remember, debtors control, like any account, is a T account. So on the debit side, I had the 340, and on the credit side, I had these two amounts here, the 5.6 and 34,400. Okay, so now I have these amounts here. Fine. Okay, you guys don't do accruals, but we're gonna do that, I suppose. Okay. Then I wanna go. Let me see. I remember skipping one here. What is that one? Okay, so since I'm at depreciation, I'm gonna go back to that other one up here. But the first things first. Here is my PPE, my note number 3. Okay. So this is my non-current assets. So as you can see, I have land and buildings, I have vehicles, I have equipment, I have furniture, right? Now, I have to look at these balances and put the amounts that that I have, the amounts that I have where they need to be. So remember, all of these balances at the end of the year, unless otherwise stated. So land and buildings, vehicles, equipment amounts at the end of the year. So 2.5, 1.2, 800 are down here. 2.5, 1.2, 800. So I highlighted all the, I made all the amounts that I have in my trial balance bold. So you can see, so those are my first 3 over there. Then my accumulated depreciation is 580 at the beginning of the year. So it's this one over here, right? This one over here. And then it's 198 at the end of the year. So it's that one over there, right? Also the last thing that I forgot, 2.5. So the first of these, the 2.5, the 1.2, the 800, and the 550, sorry. The 550 is at the beginning of the year, so it's up here. So 550, 800, these are your cost prices, and these two are your accumulated depreciations. Okay. Land and buildings does not depreciate in value. Rather, it goes up in value normally. Okay, under normal circumstances, we will take land and buildings as appreciating, not depreciating. Okay, you will also notice my cumulative depreciation for furniture, we don't know what it is, so I'm not going to bold anything here. Okay, so now let's go back to the question. The owner contributed equipment with a cost price of 250 on the 1st of September 2016. Now, immediately, without any calculation, you will add that equipment here. So that's 2.5. You're gonna add it over there. Maybe I will make them. I wanna make them a different color as you complete them. I'll make it blue now. It doesn't show well. Red. I'll make them red. Okay. So the 2.5 is already done over there, right? Or maybe I can just highlight them. Yeah, I think that works. And then I'll highlight these amounts as well. Or not. Okay. So then we can calculate this depreciation and put it aside for now. We could do that. Okay. So if I go up here, this is equipment. Equipment at 33 and 5.6 per annum on cost. Take into account, okay, before I go into take into account, this is how we calculate our equipment, right? So I need to calculate depreciation of every asset that we own during the time that we had it, right? So every year I'll calculate the depreciation for that year that I had the asset. So I had this from the 1st of September to the I still have it. So from the 1st of September, that's when I have it. Where is my, there it is. So what I need you to do always is to draw yourself a timeline if you're given a depreciation calculation. A timeline will help you quite a bit. So if I go scroll here and I enable my, no, let me not, in fact, let me open a Word document. Then I can draw on that instead. Okay, so you draw yourself a timeline, and it looks something like this. Okay, I don't like it selecting everything. So the year, when does the year start and when does the year end? It's the 1st of April. Okay, the 1st of April, so that's the 4th month, to the 31st of March, right? So we bought this thing on the, when did we buy it? The 1st of September, something like that. Let me just see. The owner contributed on the 1st of September. Okay, so the 1st of September. So from the 1st of September to the 31st of March, we have, I'm going to count now. We have September, October, November, December, January, February, March. That's 7 months. We've had this thing for 7 months, right? So now I'm going to say 250. Okay, I'll do it here in Excel actually. Oh, okay, actually it's already done in Excel. So back there, so 7 months, so I'm gonna come over here. Sold there. So I have 250, right? Multiplied by 7 months over 12 months, right? Multiplied by 33 and 5/6%, right? And that's gonna give me my depreciation. So it'll look something like this. First, to do it on a calculator. Okay, I think I'm opening way too many things. But I'll do it for this one since I have it open already. 250,000 multiplied by 7 months over 12 months multiplied by, what was that percentage again? 33. Yeah, you see, this is why we need scientific calculators. Okay, I'm going to put it in brackets. 250 multiplied by 7 divided by 12. Multiplied by, in brackets, 33 plus 5 divided by 6, close brackets. I forgot the percentage of course. Okay, I'm gonna stop there. I'm not gonna try to get it. You're just wasting time. Okay, so if I did on my Casio, what I would do is I'll say 250 to 3, and I multiply by 7 over 12. And I'm gonna multiply it by 33, and then I'm gonna press shift fraction button, and then I'm gonna go 5 over 6%. And then I'm gonna get that 49,340 rand, and this is me just rounding it up. I'm gonna hold it there for now. I'm calculating I need to calculate 3 amounts when I account for depreciation. I need to calculate the amount, the depreciation of our assets sold, depreciation of the assets that we just bought. So whatever we just bought, we calculate that. And then we need to calculate our depreciation for the rest of our assets. And then we will add the new depreciation, like the new one that we bought, with the remaining assets. Okay, so just have that number in mind over there. I'm gonna mark that. Okay, fine. Then I come down here, and I'm gonna continue with equipment because I want to finish with equipment. And remember, equipment, we already have these two amounts here. And in fact, immediately we could have just said 800 minus the 198 will give us the 601. Okay, so I can say that is also done. So take into account that office computer was this okay. Taking that office computer with the cost price of 42,000 and accumulated depreciation of 10,000 as at the 31st of August 2016 was sold for 32,000 on the 1st of January. It had been bought on the 1st of April 2016. Okay, let me see. So we bought it at the beginning of this year. Yeah, we bought it at the beginning of this year. Okay. So we bought at the beginning of this year. Where's my Word document? I think we bought at the beginning of this year. I'm the one who designed the question, but the question seems a bit weird. Put it there. There we go. Okay. That's better. Okay. So you bought it the 1st of April, which is there. Let me see. The 1st of August, okay. And the depreciation of that. And we sold this thing on the 1st of January. Okay. We sold it there. So the 1st of April, I'm gonna count now. April, May, June. We sold it. When did we sell it? I'm forgetting when we sold it. We sold it the 1st of January, 1/1. Okay. April, May, June, July, August, September. Okay, let me just admit. I don't know, it's not admitting. April, May, June, July, August, September, October, November, December, January. That is 10 months that we had this asset. Okay. So I'm gonna go out here, and I'm gonna go here. So here it is over here. Why did I go 4 months? Clearly there's an issue here with the date. Let me see, hold on. I know it had that accumulated depreciation. I clearly wanted this to be something else because I made it then for over 12. December. Okay, I also counted January. I wasn't supposed to count January. It's actually 9 months. December, November, October, September. Well, I suppose, I guess. Okay. So I'm just gonna do it how this did it, and I'm just gonna see if the amounts are the same actually. This is actually 9 months. Because it's April, May, June, July, August, September, October, November, December. We don't count January, so that's 9 months. But on the 31st of August, we already had a depreciation of, okay, so also I don't know, I'm calculating all the depreciation if we already have this depreciation. So from here to here, so September, October, November, December, that's 4 months. Since you already have this depreciation here. Okay. So then we have it over here, 42 multiplied by 4 months over 12 months multiplied by the depreciation percentage, we get 4,736 Rand and 66 cents. Okay. Then I'm just going to take obviously the Rand value, Rand figure. Then I'm going to say 42,000 minus 10,000, the original depreciation that we had on it, minus the now depreciation that we just calculated. Also, it's weird that we are calculating depreciation at the middle of the year, but I suppose I was trying to be tricky when I designed this. Minus this last depreciation, then we have a carrying value, right? Carrying value here of 27,263 rand. Remember, we sold it for 32,000, so we made a profit of the difference between 32,000 and the 27,000, but it's not important for our calculations. So here it is over here. It's equipment. So disposables are always shown at carrying value. So you'll see I just said equals that amount over there. So that's that amount over there. Okay. Then I think that is it for equipment. Okay, so now I can calculate the equipment for the year. Okay, so when it comes to depreciation, okay, now when I'm doing this, I'm remembering there's one other thing I didn't tell you about depreciation when you're calculating your old and remaining depreciation. Okay, so I'm just gonna open this back up again. When you're calculating your old and remaining, depending on which you have, when I say which depreciation method you're using, this is not gonna let me go to a different, is it? It's not. Can I copy everything and just take it up? Nope. Okay, I'm just gonna, okay, I know what I'm gonna do actually. So I somewhat wanna keep some of this timeline. Insert page breaks. There we go. Perfect. So when you're dealing with depreciation, the old and remaining, if you have the cost price or straight line method, remember that's the one you calculate depreciation on cost price. Straight line method. Also the recording of yesterday's session, I still have to download it off Teams. I'll do it tomorrow, and then I'll put it online, and then I'll send you guys the link. I'll do everything tomorrow. When you're doing the old and remaining, remember it's still cost price multiplied by the depreciation, right? Depreciation percentage, right? So now, when you're doing old and remaining, you must say the cost price balance, right? That's what you had in the beginning. You're going to subtract the cost price of the asset that you sold, and then you're going to multiply it by the percentage. If you have the reducing or diminishing balance method, remember this one, so this one is at cost price. Remember this one is at carrying value. So what you're going to do is the following. You're going to say cost price balance minus cost price sold, close bracket, right? That's not a bracket, that's just a C, by the way. Minus accumulated depreciation balance minus accumulated depreciation sold, close bracket, close final bracket, multiplied by the percentage. So it depends on which formula you have, okay? In this regard, we have, let me see, per annum on cost. We have cost here, so that's what you're going to use. You're going to use the first one. So you see up here for vehicles, you have diminishing balance method. And for furniture, we have reducing balance method, which is the same thing as the balance. So my remaining equipment is going to be this one. So my balance at the beginning, okay, first of all, we don't know our balance at the beginning, okay, as you can see. So we can get to this figure. So look, we have 800 Rand over here. Did not write this in the, okay, fine, it's fine. We have 800 Rand, 800,000 Rand, and I'm saying 800 Rand like it's 800 Rand. If we didn't have the figures above, I would do the following. I would take my cost price balance, I would add additions at cost price, And then I would remove cost price sold. Okay. And then for my accumulated depreciation, I'm going to put it down here. Let me make this red. And then for this one, I'll put it down here because there's not enough space, like with the cost price there. So with this one, what I would do is I would take my accumulated depreciation balance. I would subtract my accumulated depreciation sold, and then I would add my depreciation for the year. So if you want to go back up, you need to do the opposite. So what you're then going to do, what's in my eye? What you're then going to do is you're going to say your cost price balance at the end, you're going to subtract additions at cost, because remember, you didn't have the additions. You did not have any additions at the beginning of the year, right? You bought them during the year. So now you need to subtract them to get back to this figure. And then you would add back any cost price, any assets cost price that you sold, because you would have had it at the beginning. Okay. So now you have 800. You're going to subtract the 250, and you're going to add whatever the cost price of this thing is. The thing that we sold was valued at 42,000. So you're going to add the 42,000 back, subtract the 250. So if you come over here, you'll see I took D23, right, plus the 42 because I had it, and then I'm going to subtract the 250 because I didn't have it. And now I have my cost price at the beginning of the year. I can do the I will do the same for my depreciation once I have my depreciation for the year. Okay, so now that I have my cost price, I come over here, I put my cost price of 592,000, right? I'm gonna subtract the cost price of the thing that we sold. Remember that 42 here, close brackets, multiplied by the percentage, and I get the depreciation for the year, right? I get depreciation on the old and remaining assets. Now, my depreciation for the year is just these two figures added together, all right? So these two figures added together will give me my depreciation for the year. So if I go over there, you will see I added these two figures together to get my depreciation for the year. Now my depreciation for the year is complete. And now, what is the time in fact? Yeah, look at the time. My depreciation for the year is complete. So now I can calculate this figure, the one below, the 37,400. So now accumulated depreciation balance is 198, right? My accumulated depreciation sold, it is right here. Where is it? It's this one plus the 10,000. And then my what is this thing? My depreciation for the year is at 250 whatever. So if I go over here, I said D4 minus the accumulated depreciation for the year, and that's all I did. What the hell? Okay. Clearly there's an issue here. Okay. Oh no issue, no issue. Okay, okay. Another thing. So fine, it's all fine and all. I subtracted my accumulated depreciation for the year, right? And the accumulated depreciation that I would have added out of the asset that we sold would have been for the previous years, because I would have had it there, right? And I wouldn't necessarily add the 4,700. I would add the 10,000. However, I bought this asset this year. So this figure should not have the depreciation of that asset because it hadn't depreciated yet at the time of these balances. So I'll just subtract the depreciation for that year, and I have that 37,000 over there. So then this minus that will give me that amount. Why is that amount higher now? What the hell? Oh, this one is not a minus, that's why. I'm gonna make this a minus quickly. Multiplied by -1. That's better. Minus is here. Okay. So now that is also done. These two are already done. So that's how you would calculate your PPE. I'm not gonna go into detail further on the others because I'm looking at the time. And then what you would need is this amount here. So this amount here, that's what you would take out of it. So you would calculate for everything. Like I said, land and buildings, there's no depreciation. You just do it down there. I'm actually tempted to do some of the things here. I won't even lie to you. Okay. Let me see. Maybe I can squeeze in a few if I go fast enough. On vehicles at 35% per annum, according to the diminishing balance method, take into account a new vehicle was bought for 300,000, so you immediately put it there. 300,000 on the 31st of November. Okay. We bought a new vehicle, 31st of November. Where's my pen? 31st of November would be somewhere there. On the 1st of January, new vehicle was bought on 31st of September. Done. Okay, fine. We bought it there. How many months till here? December, January. So you don't count November because you bought it at the end of November. So you count from December. So December, January, February, March. That's 4 months. That's the new vehicle, right? And then let me see. On the 1st of January 2017, a vehicle with a cost price of 200. Okay, I'll get to that one just now. So this one, we're going to calculate depreciation of 4 months. So depreciation of 4 months coming up, and our percentage is 35%. So vehicles, this one. So 300,000 multiplied by 4 over 12 multiplied by 35% will give us 35,000. Okay, done with that. Then the other one, let me see, 35,000. I don't know, I said 35,000. So fine, we sold it in Jan, the 1st. It had a cost price of 200,000 as of the 1st of February 2016 and was sold for 150. Okay, timeline time. This is where it starts getting complicated, so you definitely need your timeline. Okay, so the first things first, when you bought this thing, it was the 1st of Feb. So I'm going to start with the buy. 1 February to March, so February, March, that's 2 months, right? You had it for 2 months when you bought it. And then I'll put the sold here. Oh, it's gonna be a weird 4. 31, 3. Okay. Then you sold it on, let me see. You sold it. Sure, okay, the 1st of January, that's when you sold it. A vehicle with the cost price of that was sold for 150,000. Okay. So on the 1st of March, January, 1 Jan, that's when you sold it. So now there's depreciation here. So you're gonna count April, May, June, July, August, September. Sorry, April, May, June, July, August, September, October, November, December, and you're gonna stop there. That's 9 months. Okay. I'm just gonna read one last time. On the 1st of Jan, a vehicle with the cost price of that, as of the 1st of February when it was bought, was sold for 150 Rand. Okay, so I'm gonna have to calculate depreciation for this year. The 1st of February, 20.6, all the way to the 31st of March, 20.6, right? And then I'm gonna calculate from this month to there. So if I go over here, the sold one. So first the 2 months, so 200,000 multiplied by 2 months over 35% will give me my depreciation of 11,000, right? And then the next year, I'm going to be multiplying this by the remaining, what is this? How many months was this? By the remaining 9 months, right? But remember, because this is diminishing balance method, I'm going to subtract the previous depreciation. So 200,000 minus the 11,667 multiplied by 9 over 12 multiplied by 35% will give me the 49,000 that I have over there, right? So together my depreciation for this vehicle is 138,000 Rand. This one is for 2016, right? So the end of 31st of what you call the 31st of March, it would already be in the balance up there. And then this one is the one for this year. Okay, fine. Then I will just say, where did I say it? I didn't say it anywhere. Okay. This is not depreciation. This. Oh, there we go. There we go. So these are my depreciations. That's my cost price, right? Minus all of this is my carry value. Because I'm like, no, there's no way my depreciation is sitting at 138. So my carry value is what I'm going to dispose this at. And then, fine, I have that. I have this. I have my depreciation for the year. You know, I'm forcing with this time thing. Okay, I'm going to stop there with going into the details of the depreciation because I'm forcing here. In any case, what I want to explain is that you would use this formula to go back up and this one to go back down. Fine. And then what you would do is you would list all these balances here. You'd get a total balance here that you are going to be taking to your PPE, your plant, property, and equipment. So you're going to be taking it over there. So I have that one. I already did this one. I'm not sure I finished receivables. Okay, fine. I'm not sure I finished receivables. The initial interest was set at 12% for your mortgage. I feel like I'm running out of time actually to be finishing all of this. Okay, fine. Mortgage bond was registered on the 1st of May, 20.6. This one is going to take too long. Okay, this is what I'm going to do. I'm going to skip everything. I know it's bad. You would have gotten these amounts elsewhere. I'm not going to skip it. On the 1st of May 20.6, interest rate was set at 12% per annum, which is raised to 14% per annum on the 1st of November and was dropped to 10%. This is going to take forever. Okay. This is going to take forever. You guys don't even do accrual, so I'm going to leave that. I'm going to leave that. This is this whole calculation over here. But what I'm trying to show is that after you add everything here, so I'm going to go back up here. Your interest income, this is all the interest that you are receiving. So this is your favorable interest. So it could be interest on debtors account. It could be interest on investment like fixed deposit. It could be interest on current account, right? And then your interest expense, this could be your interest on creditors control, your interest on overdraft, your interest on loan, like I just calculated over there. Let's see, hold on. I'll assume the network kick people off. Okay, fine. And then you would obviously you take this one as well. You have your inventories, which is I explained. Your accruals, you don't do accruals, so I just skip those ahead, which is the remaining ones over here. These are your accruals, and some of that are your interests. Fine. Then you have your equivalents, which is going to be your petty cash, your cash float. So if I go here, up here, my cash float is sitting at 35,000. My petty cash is sitting at 4,000. I take them in immediately. I have that 7.5. My mortgage bond, where is my mortgage bond? My mortgage bond is sitting there at, where is it? It's sitting there at 1.5, right? So now after I subtract the short-term portion of it, you'll get down to this one. After I subtract all that interest payments that I don't want to do. So basically, if I go back here, down here, where is it? So you have installments starting on the 30, on the, where is it? Monthly, redeemable monthly installments of 30,000 starting on the 1st of September. And those installments are here. So you have 7 of them, and they would take down the 150 down to the 129. Fine. Then your creditors control. Creditors control is sitting there. And then you'd have more accruals over here. And then your SARS is over here. And then you'd put it immediately over there. You get a full amount. Fine. Then what you would do from here, you would build this thing. I went too far. You build this thing. So now, if I go here, I already done PPE. I've already done this one. Then my trade receivables, the 343, is this 343 that you see over here. My cash equivalents of 7.5 is the 7.5 that you see over here. My mortgage bond is 129 over here. You're gonna put it over here. That trade payables is sitting over there. Okay. Financial assets are like your fixed deposit, right? So your fixed deposit is sitting there. Where is it? I know it's up here. Fixed deposit is sitting there at 550. You take it over there. Fine. Do I have, where's my bank balance? My bank balance is on the credit side, so that's an overdraft. But obviously, the other guy paid us 5.6, right? So my overdraft is a bit less. And then, like I said, the short-term portion of the loan would be taken out over there, which is those payments, those 7 payments that you would be making during the year. Fine. So now you have your non-current assets, which is these two added together. You have your current assets, which is here. You add these two, you get total assets. Then you have total equity and liability over there. And then you have your current assets added over there. You have your non-current assets. These minus these two will give you your owner's equity balance, which is your capital now. Fine. Your capital now. Then now you go to your income statement, right? I think I'm gonna stop here. I'm gonna stop here because everybody has left the session. My guess is it's either people left or they were kicked off. In either way, I'm gonna stop the session right here. And then I'll email you guys to see if you guys still want to continue these. And then we'll continue from there. But if you are watching this recording, thank you for joining. And yeah.